It's perhaps no surprise that Canada has no change in interest rates, but we did get a surprising election result. What does it mean, and what can we expect from the Fed meeting next week? We dive into the details with David Tolk, Chief Canada Macro Strategist at TD Securities. Good to have you back, David.
Thank you for the invitation.
So we still have no change in rates. What happened?
Yeah, I think we might have been a bit excited from the earlier part of the year where the Bank of Canada was a little bit more unpredictable, but I think what we've seen more recently is that the global outlook seems to be mirroring quite closely to what the Bank of Canada had expected. So as they see the view right now, there's certainly ongoing weakness within the energy sector that I think will be quite a sustained theme over the next year or so. But where we're seeing some glimmer of optimism from the bank is that the non-energy export side of the economy, so anything tied to manufacturing, at least in the bank's view, has started to improve and is expected to continue to improve. And it's that theme and that rotation away from energy more towards traditional manufacturing that gives the bank some comfort that growth will slowly rebound from here and they can stay on the sidelines and let that theme evolve as opposed to having to provide more stimulus to the economy.
So even though they came out with a little bit lower forecast for growth, they still seem to be positive that it was going to turn around, or it had turned around.
Yeah, I mean, they've been somewhat comforted by what's happened in the Canadian economy with respect to the export data. But what we see in terms of the changes to their forecast, it really was a level shift lower. So they might have been a bit too upbeat over 2016 and over 2017. So we're a little bit more realistic in that expectation. But the dynamic in terms of growth, in terms of whether things are looking better or looking worse, or accelerating or decelerating, that acceleration that they see is still in place. And I think that's really what the focus from the market should be on that steady improvement, although it is from a slightly slower starting point.
So now we had the election result this week. Does that change anything with your outlook?
Well, I think a little bit more fiscal flexibility is something that many other economies would love to see. I think you could look at the United States, for instance, where the Federal Reserve has done all it can to stimulate the economy and would really benefit, I think, from a bit of a fiscal lift. So to see both levers of the policy framework potentially in operation in Canada does, I think, maybe on the margin take some of the pressure off of the Bank of Canada to respond to a downturn in growth. But when we look at what the fiscal profile may end up being, it could be something that's more a 2016, 2017 story if we're focused more on the infrastructure side of the spending that takes a while to be implemented. So in the interim, I think the Bank of Canada will still need to be focused on a lot of the external downside risks. But as they look at the domestic economy, I think the ability for fiscal policy to provide a little bit more support does give the bank a bit of confidence.
Now, when we look to next week, U.S. Federal Reserve comes out with their next meeting minutes. Are you expecting anything?
Well, I'm probably not, and I think this is maybe something that was a little bit more contentious, especially after so much was built into the September meeting where many in the market had felt as if that was their opportunity to hike. They deferred, and now what we have seen since that meeting is that the data in the U.S. economy hasn't quite lived up to expectations. So we would look at renewed weakness in the labor market. We had a very disappointing September employment report, and more generally, consumer spending seemed to have a bit of an off month. Some of the manufacturing data also suggests that the international headwinds are hurting the U.S. economy. So if things weren't good enough in the Fed's view to hike back in September, they're certainly not looking that case in going into next week. And then we look a little bit further into the year where they have a December meeting and then starting to contemplate moves in 2016. And I think at this stage the outlook will not have improved to the point where they feel comfortable hiking in December. So we come back to our house view, at least, that the Fed will wait until March of 2016 before withdrawing stimulus. And even when they get to that point in time, it's going to be a very gradual increase in the Fed funds rate.
What about the Canadian dollar?
Yeah, I think the Canadian dollar is stuck in a bit of a cross current here. There are a couple of different themes that we'll have to push our way through. First and foremost, I think, is still the impression that the Fed, if they end up being delayed until 2016, you may see more outright US dollar weakness. So that, just as a function of the cross, might help Canada hold in reasonably well here, that will have to compete against, I think, maybe more commodity price weakness. That's something that we would anticipate showing up between now and the end of the year, so that would weigh on the Canadian dollar. And then with just the Bank of Canada and the economic performance that we should see, might also be a little bit more CAD positive. So I think you have to trade the range for the way things go for the next couple of months. But as we get into 2016, I think it's a quite clear policy divergent story where the Fed will be hiking, in our view, in March. The Bank of Canada is in no rush to follow the Fed, so that will be positive for the US dollar. And I think when we look at some of the adjustment that is taking place in Canada's economy, we will need to see a structurally weaker Canadian dollar over a much longer horizon. So we're anticipating seeing dollar CAD somewhere around 137 or so by the middle of next year, and that's just, I think, a step towards a better chance, at least, for the resources within Canada's economy to shift out of the energy sector more towards manufacturing.
All right, thank you very much, David.
You're very welcome.
I've been joined by David Tolk, Chief Canada Macro Strategist, TD Securities. I'm MaryAnn. Thanks for watching.